much. Thank you very much. As Rich said, my name is Ed Edwin. I'm a proud Olin alum, and I've had the good fortune to be a part of this conference for the last, 4 or 5 years now. And I'm always astonished at the caliber of speakers that we're able to bring to this audience here in St. Louis and virtually around the country. This year's iteration is no different. It's right up there with all of the best of them. And that's starting with our opening session. So I am honored to introduce our opening speaker, Cliff Asness, the co-founder and managing partner of AQR Capital Management. Cliff's a highly respected figure in the finance industry with over 3 decades of experience in the field. He earned his PhD in finance from the University of Chicago, where he studied under Eugene Fama, one of the most influential economists of our time. Cliff's work at AQR has been instrumental in advancing the field of quantitative investing. And he's known for his pioneering work on factor-based investing, which involves identifying and exploiting specific risk factors in the market to achieve better returns. Cliff's also a prolific writer and has published numerous papers on finance and investing. His research has been published in some of the most prestigious academic journals, including the Journal of Finance and the Journal of Financial Economics. In addition to his work in finance, Cliff is also a dedicated philanthropist. He's a trustee of the Santa Fe Institute, a member of the board of directors of the Manhattan Institute, and a supporter of the Robin Hood Foundation. Cliff has been recognized as one of the most influential people in finance by Time Magazine and an institutional investor. He's also been honored with numerous awards. Cliff will be joined in conversation with Professor Anjan Thakur, the interim dean of the John M. Olin Business School at WashU, and the director of doctoral programs and the John E. Simon Professor of Finance. Please join me in giving a warm welcome to Cliff Asness and Professor Thakur.
I never know if we're supposed to clap. I was clapping for him.
All right. Well, hello, everybody. So my job here is to ask short and simple questions, and then we'll spend most of the time hearing from Cliff. So let's begin with your philosophy of investing, your approach, and how that motivated you to found AQR.
Sure. Even in the short introduction, he summarized quantitative investing fairly well. I was lucky enough, and I mean the word lucky. No life path that ends up where you want it to be. It's rare to have luck not be part of it. I was at the University of Chicago in the late 1980s. I started in the PhD program when Gene Fama and Ken French, and I'm a little Chicago. I know I'm at the Olin School, but as an alum, I'm a little Chicago biased, but I do recognize they were not the only ones working on this. But to me, they were. And they were working on very early versions of what today we would call quantitative factor investing. Mm-hmm. It's funny, whenever you look back on history, we're all guilty of using like terms from today as if we were using them, then we didn't know what we were doing. They were sorting stocks on different characteristics and saying, these seem to beat these, and that developed into it. One of their most famous findings, and they used a very simplistic measure, which I think they would agree with. I would never insult them. I'm terrified of insulting them. Mm-hmm. They just looked at the price to book of a stock, and this is a business school, so I won't spend a lot of time on it. But for anyone in the audience, the book value is some accounting-based measure of what the firm is worth, but it's really not what it's worth. It's what's been paid in and what's been paid out, what earnings have accrued. The market cap is what the market thinks it's worth. So if the price to book is very high, the market is very, very optimistic about that stock. They're thinking it's worth much more than what the accumulated capital that's gone in. Fama and French showed that along with others, that the lower price stocks outperformed the higher price stocks. You can then cue it's still going on, 35 years of academic fighting over whether this result is real, and if it's real, as most seem to agree in academia, why does it happen? We can get into that if you want, but it gets a little crazy. But that was kind of factor investing 101 circa 1990. The general idea of quantitative factor investing is try to find things characteristics of stocks where on average a diversified portfolio that shares those characteristics wins over a diversified portfolio that often has the opposite characteristics. Sounds simple. Complications are, did it really win or did you just get lucky? I'm sure some people in this room have like I have committed the sin of data mining, of sitting there in front of a computer and you know the results. If you try 1,000 things and they're independent, one of those 1,000 things will look 1 out of 1,000 amazing. So you always have that hurdle. Is it real? Is it better than the other factors we have found? Can it be implemented? Can it be traded? Some factors that are, if you say, I want to be in and out of the stock every 12 seconds, well, nowadays we're a little closer to being able to do that, but that maybe doesn't make money, even if it looks like it does. So a lot of the next 35 years is a history of taking that initial Fama French kind of result, saying, are there better ways to measure that? If you believe that's come to be called the value factor. I have admitted that is a terrible name for the factor, and I'm apologizing for all of academia and all of quant. Quants get in fights, not real fights, because quants lose real fights, but rhetorical fights with Graham and Dodd type traditional stock pickers, because quants name this thing that's just priced to fundamentals. They called it value. And a good Graham and Dodd, know the company, will say, no, value is the price in the context of what's the growth, how defensible and moatable is the growth. Is this a higher or low margin business? Are things improving or getting worse? Is it a risky business or a non-risky business? A lot of the factor literature post Fama and French, and they participated in this also, I don't mean they didn't contribute more, has been adding not a ton, not 1,000, but call it 6 to 8 other kind of types of factors that all together end up looking a lot like a Graham and Dodd manager. I try to be a peacemaker at some conferences where I go, we're all looking for the same thing. At the end of the day, there is a big difference. A traditional stock picker is looking for certain characteristics, again, that overlap a lot with what quants like, but they're owning, 15 stocks. So they're learning everything in the world about those companies. They have the advantage of knowing everything in the world about those companies and the disadvantage that they darn well better be right about these 15 stocks. A quant is the other end of the spectrum. If on average, cheap beats expensive and low risk beats high risk and good short-term momentum beats bad short-term momentum and blah, 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 you don't own 15 stocks. You go long 750 stocks around the world and short perhaps 750 stocks around the world, trying to maximize the difference on the set of characteristics you believe in. Again, philosophically, no different than the Graham and Dodd manager, but a bet on whether the concept on average pays off. And so that's pretty much all I've done for the last, I have no other skills than this. I have friends who, if something goes wrong in their business, they have something to fall back on. This is it for me.
Well, I mean, it's been a big part of finance research and asset pricing, and it's dominated the literature. And so it's good to see that it's been useful in practice as well.
It has
made people a lot of money, and that's always good.
Most years, not every year.
I want to turn to the current macroeconomic environment and how do you see factor investing doing in this environment? We've gone from quantitative easing, low inflation, very stable growth economy to a lot of turbulence and COVID and high inflation and tightening and raising of interest rates, wars. So how do you see the current environment? How do you see investing in the current environment? Has your approach changed in any way?
No, that's a great question. Let me first diminish expectations if they were not low enough already. Questions directly about quant investing, I might still get them wrong, but I'm supposed to at least be an expert on this. Macro questions, obviously, I spend a ton of time looking at. You can't be in the markets if you're not looking at what's going on every day. But what my firm does is not top-down macroeconomic forecasting. We're building portfolios that we think are pretty resilient to any environment. That doesn't mean they work all the time. That just means there isn't a particular environment they're betting on against another. With that said, I will then share all of my uninformed opinions with you. I'm always leery of saying that we live in crazier, more dangerous, wackier times, because I think we're all wired to have a little hubris that now is different than the past. When if you go to the past, a lot of crazy things happen. With that said, I think we are currently living in crazy, wacky, strange times. All the things you listed, the fact that and this is very specific to what I do. I'll tell you something because it colors a lot of the things I will say. 2018 through 2020 were our worst 3 years as a firm. The last 2 years, we've more than made it up. So you don't have to worry about me. You do have to worry about me psychologically because these things are very, very hard. You can know everything. I have my wife and one of my daughters here, and they will tell you I do not take this as a cold statistical clinician at home. I trade it like a cold statistical clinician. That's a hard word to say twice correctly in front of an audience. So I do think now is a little bit crazy. The thing I look at, and I'm going to make it into more of a quant geek thing. The spread, if you take, I discussed one of the most famous factors, not a dominant factor. We go through years where I hardly talk about it, but what Fama and French, but not the Graham and Dodd people would call that value factor. That was the cause of 18 through 20 being excruciating. Every company that was expensive and beloved became 18 times more expensive and 18 times more beloved. That was going on pre-COVID. COVID sent it into the stratosphere. I know we're all trying to forget those couple of years. I often leave them out of my stories, not because we lost money, but just because I'm stupid. When I'm telling a story, I'll go, that was 3 years ago. And people keep reminding me, you got to add in 2.5 years for COVID. I'm like, oh yeah, that was 5.5 years ago. But when COVID hit, the only stock you needed to own was like Peloton and Tesla, right? And every other company in the world was going to go out of business. That actually remains. The spread between cheap and expensive went to world record wides. I'll tell you, I lived through one comparable period, and this is before most of your times. But the dot-com bubble, the 99-2000, was a very similar period. You know, they always joke history doesn't repeat, but it does rhyme. This rhymed a lot. It's not exactly the same, but it shared a lot of characteristics where cheap got destroyed by expensive. Something that we built back then that is now used by a lot of other people, examining the actual spread between cheap and expensive. This sounds really obvious, right? If you line up stocks by your favorite, you don't have to be Fama French, you can use whatever valuation measures you'd like, and you go long the cheap and short the expensive. A lot of academic work then just looks at that average return over time. It was so destroyed that it pushed us to look at how big are these differences? Let's not just sort stocks and go long the cheap and short the expensive. How cheap and how expensive? And believe it or not, this is a benefit of being old. You get to have looked at some problems that sound staggeringly obvious, but they either weren't or you were one of the first doing it, so you get credit for the staggeringly obvious. The spread between cheap and expensive in the tech bubble got to the widest we had ever seen in 50 years. People were wildly optimistic about what they liked and wildly pessimistic about what they disliked. Here's something I just flat out got wrong. I don't think anyone ever actually asked me, so I didn't get it wrong out loud. But if somebody had asked, I would have been dead wrong. I never thought I would see something more extreme in terms of mispricings than the dot-com bubble in my career. You should never, anyone who's going to go into finance, never say never. Crazy stuff happens, but I would have said it was highly unlikely. I will make a poor excuse. Anything is an excuse. COVID ate my alpha. Things were getting there, but it didn't go past the dot-com bubble till COVID hit, and then it went completely past it. So there's an example. I think when you tie that in to your original question, which I do occasionally remember, on the macroeconomy and the scary things going on in the world, the link here, a lot of people talk about it, including me. The link is very hard to pin down causally, but extremely cheap money for a long period, feeding frenzies like this. Notice I use words like frenzy. I even use word like bubbles. When I was Gene Fama's student in the 80s, I would not use those words because I wanted to graduate. He was actually very nice about dissent. I wrote a dissertation for him largely on the price momentum strategy, saying that it's actually an effective complement to value. And I was terrified, I'm telling you, aside anecdotes, I was terrified going to tell him I wanted to write this because it's very much not an efficient market Gene Fama dissertation to say you can make money just by buying what's been going up and selling what's been going down. And he looked and he said, if it's in the data, write the paper, which felt kind of like a religious statement from the man. Never liked the fact that it was true, but didn't blame me. Does that make any sense? So we ended up seeing, and I think it was macroeconomically driven ultimately by this incredibly accommodative and the panic of COVID, dislocations much bigger. If you want to get into the current macro, I'll go all the way back, and I will, even though I said I'm not an expert. I'm not the guy to tell you inflation's going to last longer or last shorter than people think. The thing we probably feel most strongly about is, for those of you who look at the markets at some frequency, the bond market is not just pricing in an end to Fed hikes, but it's pricing in multiple cuts to rates. And you can look at what's called the yield curve and what the yield on different bonds are further out. And so it could be a risk premium, but a lot of people interpreted it as a forecast of where short-term rates will be. And if you go by that, it looks like the Fed's going to cut like 7 times in the next year and a half. Probably the only world that happens is where we don't just have a mild, but a pretty severe recession. Equities are still very happy. They didn't have a good year last year, but they have had a good year this year. They're still priced to historically expensive levels. We do not know which side will be right, but we do think there's a pretty massive disconnect between what the bond market is looking at and what the equity market is looking at. And it has to do with inflation and recessions. I wish I knew which one was going to win. But even knowing that there's a disconnect, you can put on some interesting positions that I think help.
Okay. Well, let's turn to a fun topic. Not that these topics were not fun, but from the time that I was in the PhD program up until quite recently, in finance, we've had this very clear, unambiguous objective function for the firm, right? Maximize shareholder value, goes all the way back to Milton Friedman, and there's a lot of good rational thinking behind it. But in recent years, that's changed a little bit. The Business Roundtable, Larry Fink of BlackRock and others have come and said, you can't just focus on that. You've got to take other pro-social agendas into account if you're the corporation, like the environment and ESG and so on. And then there's also been backlash against it recently.
Sure.
That, that has some disadvantages too. And people have called it woke capitalism and it doesn't work and so on. So what are your thoughts on that?
Well, this is a complicated one.
Yep.
Because I do think that ESG has some theoretical issues with it. It has been oversold to investors in terms of what it can do. I also think the backlash against it is well overdone. And I start out, Milton Friedman's idea that a corporation, and it always sounds ugly, right, is not moral. It's trying to maximize profits to its shareholders. And his framework, which may get me in trouble on a college campus, I may be kicked out as crazed reactionary at this point, which will only be the 3rd time this week that has happened. His concept was it's the government's job to decide the rules. What should be taxed because it's a so-called externality upon other people or upon the whole globe? What kind of composition of your firm has to be X. And then it's a firm's job to work within that to maximize profits. And like you said, under some fairly general conditions, you can show that's a pretty good outcome for society. But none of that says that the individuals who own the firm aren't allowed to ignore Milton and say, we have other priorities we care about. And pick one, emissions. A lot of people care a lot, and they're probably right to care. As the owners of the firm, they're allowed to say, we're going to mostly maximize profits, but we're also going to care about this. Now, there are still problems, still issues. One, who's deciding this? I have zero problem with shareholders. Even you can have a vote, it could be a supermajority. I'm not going to dictate the governance, but with shareholders deciding what to do with their own money. Yeah, if their priorities say do this, I respect Larry Fink. BlackRock's a public company. I don't think he necessarily should get to decide these priorities. So to the extent it comes from the actual owners, yeah, if you ran your own private business, you don't have to maximize profits.
Right.
You probably will go bankrupt really quick if you don't ever think about them, but you're allowed to consider other things. So I'm very open to that. I do worry about the governance issues because these things become captured and whatnot. The other, and this is one I've written on that briefly made everyone in ESG hate me. They either don't hate me now or they're more clever about it. I don't know. But ESG is often sold to investors. There's so many different flavors. This is another problem. So many different flavors and varieties, and you can have two different services that tell you what are the better and worse companies on these that don't agree nearly as much as you think they would agree. So there are practical issues, but ESG at its simplest is care about these other things. That often takes the form of you're not allowed to buy out of 5,000 stocks in the world, these 600 companies. Call them the bad guys. That's fine. Again, if the shareholders say this is what we want, and we don't believe in what these companies are doing. The issue here is how does that change the world? And this is something that bugs me because I think it's often left out. It can't be just a symbol, right? It can't be just we are doing good and therefore we feel good, but how are you actually changing things? And there is a mechanism, but people in ESG don't like it so much. The mechanism is the following. If you are a good person and will not own these companies, I am not a good person. I am still solely focused on the return and the risk of my portfolio with no other concerns. If you own them, and obviously you and I would be tiny parts of the market, but if we were big segments of the market, if you own them, I have to own more than I wanted to. The market has to do what's called clearing. It has to end up, there's a price for everything, as cynical as that may sound. So for me to own more of the bad guys, even though I'm indifferent, not actually bad, I don't actually like the bad guys better, I have to be induced to do that. The way I'm induced to do that is generally through a lower price. A lower price means a higher long-term return. So the bad news for ESG is in this form. There's a totally separate form of ESG that I know I'm less involved with, but is totally legitimate, which is instead of not owning the bad guys, own a lot of the bad guys and show up to the meetings and try to change things. That is absolutely a separate branch. It's just not one the quants. You don't want to hire a quant to show up to the meeting. You want to. So if ESG means I get a higher return, you get a slightly lower return for your virtue. It's a little annoying, right? But the good news is this is how behavior is actually changed in the world, because expected returns, and some of you, I hope, are taking these courses, expected returns are also discount rates. When you sit down, and some of you I know have taken this, where you're trying to decide, should a firm engage in this project? You have numerators of cash flows over time, and you're discounting that cash flow at some required return. If that required return is higher, more often than not, unless the cash flow is very weirdly shaped through time, Some smart guy always brings that up and I get annoyed. But if you have a normal looking project, the higher the expected return, the less attractive the project. It has to clear a higher hurdle. And the bad guys do less of the bad stuff. So one of my issues with ESG, I think it can be wonderful. And it's not only nothing wrong, it's wonderful that people pursue what they believe in with their own money. But I don't think it's kind of fully grown up to recognize why it works, how it works, and what those ramifications are. Unless you have some special secret alpha among ESG stocks, I think in general, you're doing a noble act, but giving a little bit up to make the world better. And I think it can make the world better. So I'm sorry for that answer looped back around on itself 2 or 3 times, but I think it ultimately holds together. Maybe.
No, it's a fascinating topic. And I know that even in the existing literature, there are arguments on both sides, a lot of controversy about how well the firms that do well on ESG actually, how well do they perform for the environment and so on. Let me turn to market efficiency. So, when you went through the PhD program and I went through the PhD program, market efficiency was religion, right? And you referred to this earlier, and how can you go to Gene Fama and say that something is inconsistent with efficient markets, right? You couldn't do that. If you sent a paper to a journal and you concluded that there was some market inefficiency, it was sure to get rejected. So you had to apologize for it, right? But then the world has changed. And, we had this period where it was fashionable to find all forms of market inefficiencies, right? So where do you see things standing now? Has the market grown more efficient or less efficient over the past, say, 25 years?
I'm going to say something odd. I think it has gotten somewhat less efficient. And just so we all know, the efficient market hypothesis is a very simple one. The prices reflect all available information. As Gene Fama points out through generations of students, to really test it, you need to test it joint with some model of how prices are set, because you need to know what the rational way to set a price is to see if it's reflected. To your point, it seemed to survive the initial tests. This is anywhere from the late 60s to the early 80s. And then holes in the story started to appear. Probably the original one, which we're actually not huge believers in, but the original one was small firms seem now perform large firms by more than an efficient market story could explain. Fama and French's value factor, which, as you recall, should never have been named the value factor, was maybe the second. After that, people added things like profitability, lower risk securities do a fair amount better than they probably should. If you buy lower risk, you should get lower return in an efficient market. Fisher Black discovered this in the early 70s, then it was buried for about 15 years, and then a few professors resurrected it. But buying low volatility, low beta kind of securities got you pretty much the same return as the rest of the market for less risk. And it's very hard to find a theory that reconciles that with efficient market. So I think my personal journey, when I was writing a dissertation for Gene, and you were kind to call it 25 years, because it's 33 years ago. The date in my dissertation ended in 1990. Most of your lives are what I call my out of sample period. But even then, as we just discussed, I was not a pure efficient marketer. It's momentum, it's possible. People will go through great tortured exercises to try to figure out how could buying what's been going up and selling what's been going down be consistent with a rational market that only pays you for risk. I don't think they've done a very good job with momentum. I've tried, and I've not done a very good job with momentum. Value, you can make an argument either way. The flip side to if a certain thing works, meaning a diversified portfolio of cheap on average over the long term, not all the time, beats a diversified portfolio of expensive, why can be an efficient market reason that it's riskier, and you should get paid more if it's riskier, or it can be an inefficient market reason. Behavior, of people is imperfect, and it leads them to pay too much for the things they think are darlings, glamour stocks that are often called, and too little for stocks that are in the doghouse. That is not an efficient market, that's an error. And that's kind of the battle lines. So I started out with Dean writing a dissertation on momentum, but I was probably still 80-20 an efficient marketer. I wouldn't say I've completely flipped, but I'm probably 70-30 a behavioralist at this point. A few things. Having lived, sometimes barely lived, through the dot-com bubble, the GFC, and 18 through 20, which was an extremely irrational period. If you believe irrational periods occur, as I now do, it was an extreme one. If that doesn't move you on the spectrum from thinking markets are perfect to thinking they are somewhat less than perfect, I would argue you just haven't been paying a ton of attention. But why? Partly, I think they were always less efficient, but you also ask, have they become less efficient through time? That runs very counter to intuition. We all know technology has advanced dramatically, right? You get all the information you can want in nanoseconds from when it's announced. You can slice and dice the information any way you would like. And I'm going to write about this soon, though I like writing about data. I will write opinion pieces, but I'm always feel like I'm on dodgier ground. And this is largely an opinion. There's not a lot of hard data on it. But I think more information faster has been grossly oversold as making us better at processing that information and coming to the right conclusion. It has probably made us way better at incorporating that information quickly. I think if you hear an earnings announcement 35 years ago, if you immediately were the first to hear it and you traded, it was probably a small edge. Not talking about cheating here, I'm just talking about being the first. I think that edge has gotten down in nanoseconds. So in that kind of way, the market has gotten more efficient. But in processing information, the analogy I make, and it's only an analogy, is to social media. It was supposed to make us happier and like each other more. Does anyone want to take the other side of that one, that it actually has? So like having access to these tools can actually, in some cases, go the other way. You can have an illusion of control. A lot of people are, from professional portfolio managers to people sitting at home, that think if they have 12 fancy screens in every piece of data, that the price has to be right. And I actually think it's gone at least mildly the other way. The evidence that markets have gone through more crazy periods with more extreme mispricings in the last 30 years than they had in the prior 50 years. I think it's pretty strong. So there is some data behind this. So I'm actually, this isn't, I still think, for anyone who was panicked that I'm not a capitalist anymore, I still can't think of a better way to allocate capital than by markets. But my belief in their perfection, while never 100%, has gone down over time, both because of the natural finding of other things that I think have been inefficient market causes. And I think things have actually gotten slightly less informationally efficient, which is interesting because it makes being an active manager, I think, long-term more lucrative, but more excruciating for longer periods, right? Yep. If something is less efficient, that also means it can wander from whatever is fair for longer. That should be good news if your job is to take advantage of other people's mistakes, help your clients, make prices more accurate, make money. But if it wanders a tremendous amount for 5 years, maybe you don't last to see the other end. I have a story. I'm going to embarrass my wife. This was late 1999, my first go around with the starting to think maybe markets aren't perfect in the dot-com bubble. I was home one night after we started our firm in mid to late 98. So the first month was very good. That was a month where the S&P dropped 20%. Russia defaulted on, it's always Russia, it's still Russia. Defaulted on its debt. That was fine, but the next 18 months were the blowing up of the dot-com bubble. So that was simply a horrible experience for us. Over time, when I started way back then, if you asked me, what does it take to outperform long term as a money manager, I think I would have given you an arrogant answer that had some flavor of just being smarter, building better models, being smarter than other investors, than the market. I still think that's good. Write that down, it's important. Smart is still good. But I think that's literally half the battle. Now, I think half the battle is being able to stick with something that you believe in for hopefully rational reasons. You want to keep an open mind, you might be wrong. It doesn't mean you're right. But I think those wandering away from any kind of fair value, going forward, unless the world changes a lot from here, will be more profitable for those who can survive them, and fewer will be able to survive them because of this. Oh, I didn't tell you the story about 99 and my wife. I'm sorry. She thought she was going to escape for a second. During this crazy period where we're losing all this money in the beginning of our firm, which is the worst time to lose money. Write this down too. Get lucky early. Even if luck is even over your whole life, the first year and a half is a good time to get lucky. I'm at home. We're newly married. As an aside, and I'm sure she remembers this, I would occasionally refer to 1999 as the worst year of my life. And she asked me very nicely if I would refer to it as the worst professional year of my life. And I did switch to that, and that is what I meant. But I was home one night and I'm complaining about how, and I was probably cursing up a blue streak, how blankety blank crazy the world is. And I was offended by this. It was costing us all this money. And she said something very simple. I filled in the rest after. She's too nice to fill in all the rest. She said, I thought you make your money partially because people make mistakes. And that's where she left it. But the rest is implied. Now you're whining and cursing up a storm that the mistakes are too big. And this is not unique to me or value managers or quants. Any investor taking an active position wants the world to present them with opportunities to be right, and wants the world to admit they're right an hour and a half after they put the position on. And it never has worked that way, but I think the periodicity, if anything, has in my career, I've seen it get more extreme. So a very long-winded way to answer your question. I apologize, but I think the market has gotten somewhat less efficient, making it, frankly, thinking about careers, more lucrative if you can do it, but harder to do and more painful.
Okay. Well, we probably have time for one more question, but.
Well, you've noticed I go for 11 minutes on each one.
But you were in the city with the St. Louis Blues, won the Stanley Cup, and one of your
yeah, thanks for Tarasenko. It didn't work out at all.
Yeah, it's not about investing, but it's
he was good.
Pulling the goalie, investment lessons learned from watching hockey. So tell us a little bit about that and what the relationship is to investing.
Okay, so a colleague and I wrote a paper on hockey. First of all, I should be thankful for this, but I'm still a little miffed that by far my most downloaded paper ever is the only one I wrote not on my field. I had an idea for a model for if you're a coach in a hockey game, when to pull the goaltender. And of course, every one of you knows hockey, but I will explain very briefly anyway. Normally, if you play 5 people and a goaltender, pulling the goaltender, if you play 6 people without a goaltender, the chance of you scoring goes up a little, and the chance of them scoring, because there's nobody tending goal, goes up a lot. That makes it early in the game, a tie game, just a fundamentally idiotic strategy. No one would do it unless there was some practical joke-like reason for it. But imagine there's 10 seconds left in the game. And you can, if hockey fans, you're in their zone, 10 seconds left in the game, you'd absolutely do it. Because, yeah, the chances are larger they'll score than you'll score. But in most instances, losing by 2 is no worse than losing by 1. So the fact that your chance of scoring goes up at all dominates. It's the only thing that matters. So you can set up a model and you work backwards. We divided the world into 10-second increments and said, what if you act optimally in the last 10 seconds? At 20 seconds, what if you act optimally? And you could just build a tree and go backwards. And it turns out when to pull the goaltender. According to our model, which had some assumptions, like all models, it was about 5.5 minutes before the end of the game. And my favorite result, if you were down by 2, you were supposed to pull the goalie at about 12 minutes left in the game. Never seen in the history of the NHL. I shouldn't say that, probably some crazy game somewhere, but just never seen. And the logic, though, is down by 2 with 10 minutes left, you are deep out of the money. If you want one investing analogy is options. Options care about volatility, not expected return. If you're long an option, you want volatility. And at that point, you need a lot of volatility to have any chance of winning. So here's the real question. If we're right, and by the way, we thought we were like among the first people ever to mathematically consider this. It turns out we're very early for Americans, but there have been 97 Canadian papers written on the same topic. Thankfully, none of them took the exact method we did, and most of them come out with fairly similar answers. And when you're doing modeling, people approaching it very different ways, coming up with a similar answer. It's never a proof, but you start to feel better and better that there's some truth. But the interesting question for investing is, how come nobody does this? If we are right, big if, but I hope it's true. If we are right, why don't people do this? And the answers come out very similar to why people don't do certain things in investing. When something is on the face of it dirt cheap, but might get cheaper before it gets better. A Vulcan investing says, I'm going to buy some now, and if it gets cheaper, I'll buy more. A real-life human might say, first of all, that's terrifying. Second of all, I might get fired. Even the Vulcan would be concerned about getting fired, probably. So in the real world, there are a lot of reasons people don't always do the theoretically optimal strategy. They turn out to be very similar to the reasons in hockey. Most of the time, the strategy fails. When you pull the goaltender, most of the time, sadly, they score on your empty net, and the game is over, and you've lost by more. In fact, if you follow the Asness and Brown, it's my co-authors, strategy, down by a sufficient number of goals, you'd pull the goalie in the first period. So you're down 6-0. I think the math supports that. You have no chance of winning. What you're actually hoping is to score a goal with the goalie pulled, make it 5, and then put the goalie back in for a while, because then you're in a different situation. Of course, if you follow the Asness and Brown method and you do this, there is some chance you lose 27-0. And it turns out that is rather embarrassing and affects careers. It turns out doing anything unorthodox that doesn't work affects careers. There's an old cliche that's not just in investing, but losing orthodoxly in an orthodox manner is survivable. Losing in an unorthodox manner is not. So what you tend to see when there is this just disconnect between what people really should be doing and what they feel they can do is you tend to see people start to creep out towards the right strategy. And you see this in investing. People like us start to systematically do this. And I don't think we've hit this, but if there are enough of us, it would go away eventually. And they have. And I don't think Aaron and I influenced this at all. I'm not quite that arrogant. But they have moved out from about a minute when I was a kid to maybe about 2 minutes now in when they pull the goaltender. So I kind of like that. They're not there yet, but they're showing some indication of what's going on. And I just think it's fascinating insight into real life behavioral issues. And by the way, these coaches are not irrational. They are not simply concerned with maximizing the points in the standings. They are also concerned with keeping their jobs. And maybe as an owner, you wish every coach was an altruist who would sacrifice his entire career on the altar of an expected .03 more points in a game because of Asness and Brown. 2016. But it doesn't work that way. And so we spent a lot of time. We actually wrote this piece on hockey in the Journal of Portfolio Management, because much of the piece was talking about many other parallels, but they're all in the same spirit. Why do people not do the optimal thing, assuming we agree on what the optimal thing is? Separately, if you disagree, of course. But often people will even agree and go, I can't do that. And the analogies to why people don't do it in hockey, very similar. It happens in other sports. I didn't do this, but people have changed the game of American football by going for it on fourth down more if you're on the 40th yard line. And one of the early results, I don't know if it's true, is they showed that older, more successful coaches were more likely to act optimally. And they didn't do so early in their career. So I'm not saying that's how they became more successful. What we're saying is when their jobs are more secure, they have more latitude. Nobody's firing Bill Belichick for going for it on fourth down once. In fact, there'll still be nasty articles written in the Boston Globe if it doesn't work. But he's not losing his job. And it's more evidence that there really is a behavioral phenomenon going on here. And it was kind of fun to go to another field and see just the exact same things.
Yeah, no, I was actually going to mention that fourth down strategy. There's a paper in the Economics Journal on when should you go for it on fourth down. It's very counterintuitive to somebody who's a football fan, because it's like almost every single time relative to what you see in practice. So
much more. Yeah. And they've moved in that direction, but not all the way.
Yeah, exactly. So I think we are out of time. Cliff, this was fantastic. Thank you for sharing all your insights.
I had a good time. Thank you.
So.